Right. Good morning, students. So we are discussing about capital structure theory. In the last class, we have discussed on a net income approach. Today, uh, we will continue the net operating income approach. We have discussed most of the areas under this theory, net operating income approach. So this theory says the capital structure, so mix of capital structure has no impact on the value of the firm or overall cost of capital. That is the main argument. So it has one example. This example says the net operating income is 1,350, market value is 1,800 at 10% interest rate, and overall cost of capital 15. From this, we will find the value of the firm and cost of capital. Right here, the profit is given 1,150 and overall cost of capital is 15%. Value of the firm is taken 9,000. How we get it? Profit divided by overall cost of capital equal 9,000, and value of the debt is 1,800. Therefore, balance is 9,000 minus debt equal 7,200. It's equal to equity. From this, we will calculate cost of equity KE from this way. Here, given profit is 1,350 minus interest is 180. It's come. How we get it is debt capital is 1,800 and 10% of this is 180. So therefore, net profit minus interest equal 1,170. Then value of equity is 7,200. This figure has been taken here. So this value, net profit, is divided by value of equity, then cost of equity equal to 16.25. Right? Then what is the rate of return on equity if debt equal 3,000? Right? Debt equal 3,000. Then we have worked out on this. So profit is remain unchanged, and overall cost of capital also remain unchanged, and value of the firm is 9,000. Value of the firm is not changed, but the debt capital is 3,000. Earlier it was 1,800. Now it is equal to 3,000. So value of the firm is 9,000 and value of the debt is 3,000. Therefore, the balance figure is equal to equity, value of equity, right? And the profit also same. And now interest payment has increases. So 300 rupees, 10% of this 3,000 debt, and balance net profit is 1,050, and value of equity shares is 6,000. So it has been taken from here, 6,000. So 1,050 divided by 6,000, it's equal to cost of equity. Now cost of equity has increased from 16.25 to 17.50. Right? We will take this scenario like this. So earlier 1,800, scenario 1, right? Scenario 1, scenario 2, case 2. Right. Earlier the debt was 1,800, equity is 7,200. So total value of the firm is 9,000. And debt equity ratio. How do we get debt equity ratio? So debt is 1,800. Total value of the total equity is 7,200. Therefore, it's equal 0.25. It is one way of calculating leverage. And we can calculate leverage like this. So total value of debt is 1,800. Total value of the firm is 9,000. It is equal to 0.2. We have taken like this, value of the firm, right? And the value of equity over value, right? So equity is how much? So 1 minus 0.2, then we will get this value, or you can get 7,200 divided by 9,000 equal 0.8. And we have calculated overall cost of capital is 15. How do we calculate overall cost of capital? Right, from using this formula. Okay. So overall cost of capital equal, how we get it? KD is how much? It's 10%. Here is equal 0.1 into debt over value of the firm. Debt over value of the firm is equal to this, plus cost of equity. How much? Cost of equity, the earlier situation is 16.25 into share capital over value of the firm, equity of the value of the firm, like this. Then overall cost of capital is equal to 15. In the second case, now debt has increased into from 1,800 to 3,000, and therefore value of the firm equals, value of the equity equals 6,000, value of the firm is 9,000. The debt equity ratio now has become 50% debt equity ratio, and value of the firm, debt to value of the firm ratio is 0.33, right? How we get this value? Debt over value of the firm, 3,000 divided by 9,000, so it's equal 0.99. Now equity value for equity and value of the firm ratio equal, equity is 6,000 divided by 9,000, then equal to 0.67. Now we will let us calculate the overall cost of capital, right? Cost of debt is remain unchanged, is equal to 0.1 into debt value of, right, this value, right? How, what is that? Debt over total value of the firm, plus cost of equity, that is equal to 17.5 this case, into how much? Equity of value of the firm ratio. Now here in both cases, overall cost of capital KO equal 15,000. Even here the thing is, earlier 1,800 debt, now 3,000. Earlier equity was 7,200, now 6,000. So the capital structure has changed. This is the capital structure. This is the capital structure. Earlier capital structure was debt equity ratio 0.25, now 50. Earlier debt to total value of the firm is 0.2, now is 0.33. Anyhow, there is no changes in overall cost of capital, weighted average cost of capital. There is no change here. That's what the theory says, right? Here the value of the firm also remain unchanged. Value of the firm also remain unchanged. Here the profit is 1,350, no, 50. In both cases the same profit, right? And cost of capital is this value. Then value of the firm equal how much? Equal profit, this is a profit, is operating profit, net operating profit, divided by overall cost of capital, equal 9,000. The same way, right? Profit, net profit, so net operating profit divided by overall cost of capital equal 9,000, right? Here so remain unchanged, because overall cost of capital is remain unchanged. But the change we can observe here. Earlier capital structure is like this, now capital structure is like this, but the changes in capital structure have no impact on the value of the firm or overall cost of capital, right? So this theory states that the changes in capital structure will have no impact on value of the firm. So this is the conclusion of the theory of net operating income theory. And also here we will take more combination. This scenario here we have taken 0.25 ratio, bank, it's a debt over equity ratio. This is debt over equity. See the calculation. Yeah, okay. Right, you see here, right? So here this figures 16.25, where we have taken 16.25 here. That time capital structure was 0.25, this one, right? That time cost of debt is 10%, cost of equity is 16.25, and it become changed to this value here. 0.25 become 0.5. This one, cost of debt remain unchanged, but cost of equity has increases this value. Like in the different combinations, so cost of debt is remain unchanged, but cost of equity has increases. Finally, overall cost of capital has no impact. So examine a variety of different debt equity ratios, and the resulting required rate of return is like this. Here, when we explain this theory in the picture, it's like that. Here, cost of capital, and here financial leverage. So when financial leverage increases, it means the debt component has increases in the capital structure. This picture is like this, right? Here, now earlier, initially it was 15%. The overall cost of capital is equal to cost of equity. When they increase the debt capital into the capital structure, here the cost of equity has been increases, continuously increase, but there is no change in cost of debt. Finally, it has no impact on overall cost of capital. So this is the argument of net operating income approach. Okay. This is a summary of net income approach. So critical assumption is overall cost of capital remain constant. Overall cost of capital is remain constant, unchanged. An increase in cheaper debt fund is exactly offset by an increase in the required rate of return of equity. So when we include the more debt, the cost of equity has increases, but the increase of cost of equity is offset by cheap source of finance, debt. As long as cost of debt is constant, cost of equity is a linear function of debt to equity ratio. Thus, there is there is one optimal capital structure. There is no one optimal capital structure. According to this argument, according to net operating income argument, there is no optimal capital structure. So traditional approach, and you can find. So I have explained in the last class about the traditional approach. This is a traditional approach. So there's one point. There's one point here. So the cost of equity is remain unchanged. Cost of debt is remain unchanged, and when cost of the leverage, the debt increase, the debt component increases in the capital structure, cost of equity also has increases. But and the overall cost of capital is like this, and this is the point where the lower cost of capital. So this is the optimal capital structure, this point. And the summary of the traditional approach is the cost of capital is depend on capital structure of the firm, right? The net operating income approach, capital structure is have no impact on cost of capital and value of the firm. So it has initially low cost debt is not pricing and replaces more expensive equity financing, and overall cost of capital declines. Then increasing financial leverage and associated increase in cost of equity and cost of debt more than offset the benefit of lower cost debt financing. Thus, there is one capital structure. There is one optimum capital structure. But in net operating income approach, we can't find one optimum capital structure. In net income approach, what is the optimum capital structure? That is 100% debt, 100% debt in income approach, right? And this is also the point where the firm's or value will be the largest. Then Miller and Modigliani theory, it's not right. Then you can have your self-reading, right? You can have a self-reading on arbitrage pricing theory, arbitrage pricing model, right? And please be ready for the quiz in couple of days, and I will upload the soft copy of this book, and you can have nice. Right, I will upload this session in the LMS, and you can have and enjoy and get the knowledge and be prepared for the exam. Be safe. Thank you.